Hey guys, good evening. This is Brandon, also known as the Option Don, and I would like to take a moment to review the chart of the SPY, the S&P 500 ETF, and some of my observations, which I believe are very significant in terms of where the market is headed. So um, please just take a moment to hear me out. So first, I'd like to dedicate this video to all my followers, my subscribers, and also those that are permanently bullish, the perma bulls, the buy the dip um, cult leaders, and the lemmings. I don't know if anyone knows what lemmings are, but if you're an 80s baby like myself, you might be familiar with the video game and you'd understand what I'm talking about. But anyway, that's besides the point. Let's get back to this chart. So what I see on a weekly frame on the SPY is the structural significance of the price action is still bullish. Yes, I will add that the week ending January 9th, 2015 ended with a long-legged doji where the price action closed above the midpoint of the candle, which favors the bulls. However, it's still an indecision candle. The price action closed below the 3-week, the 5-week, and the 10-week moving averages. It maintained above the 20-week moving average and this green dot right here. That's your volatility band. The significance of the volatility band is typically when you test the level, you get relief, you get a bounce. So you go here, you bounce to here. I don't know if that's going to be the case this time around. It very well could happen that way, but the reason for this video is this is a moment of caution. I want everyone to understand what is taking place on this chart. I am seeing some technical sell signals or a slight subtle view of sell signals that are impending or soon to emerge. Right here we have a sell signal on above average volume to the sell side last week. Right here, the start of a sell signal, an impending sell signal, sell signals that are on their way of occurring. This right here, this indication, red crossing over the green, sell signal. This line right here, this yellow line, is actually very significant. The yellow line represents your ADX indication. An ADX indication represents the strength of a trend. An ADX indication with a reading of 25 or above is indicative of a strong trend. Well, the indication is at 14.45. That's indicative of a very weak trend and perhaps a reason that a change in direction or personality and behavior in this market may occur. So I'm going to zoom out to a monthly view. Let me zoom in on this chart. Well, I'll zoom out for a moment just so you can see the structural significance still within the primary bullish structure. We're testing some moving averages to the downside. Monthly view is hard to get a near-term read, but we are experiencing some early sell signals here. It will take time for this chart to shape up, but I just want to talk about, well, first I'm going to get on a cleaner view. Let me get on a clean chart so everyone can understand what I'm looking at. All right, so this is a monthly chart. SPY, the old-fashioned chart. This is what took place in 2000, 2008, and then of course, boom, what a bull market. Right here, Bernanke took office with his great quantitative easing plan. We have 3 phases of quantitative easing to stimulate the economy. Some may say the economy has been stimulated. Some may say the economy is as bad as it was in 2008. The big problem now, guys, and it's been the problem for many years, is the debt, the credit crisis. And that, I believe, will be the problem going forward. Keep in mind that our public debt is over $18 trillion. If you factor in sovereign debt and private debt, our nation is in debt roughly $60 trillion, $60 trillion. If interest rates rise in the spring of 2015, it's possible that our nation may in fact have trouble just servicing our debt, because the interest to pay down the deficit is going to be so severe, so substantial. Anyway, that's for the administration to figure out. I have no part in that. All I care about is what the chart is telling me. But I will add that ever since we've had this, well, quantitative easing has been over since the end of October, but ever since we had quantitative easing from 2009 through this time, anytime there has been a correction or any type of downside scenario in the market, it would just snap back. The market would snap back. Overall bull market. Equity just rises and rises while we're in a bad economy. Why is that? The reason is there was so much liquidity, billions of dollars of liquidity hitting the tape, hitting the bond market every single day. That's not the case anymore, guys. We don't have that stimulus. And if we don't have that stimulus, the likelihood of a correction being bought back up in a couple sessions or a couple weeks, the likelihood and probability is not as good as it was before. So it's just something to consider. So I believe that we must have, our nation must come up with some form of new stimulus package if this market is going to hold up. If it can hold up at these heights, you know, considering the sell signals that are appearing on my charts. So, okay, here's the good stuff. Where is it going if we fail? I'm going to go on my fully loaded view. On a monthly view, if the selling starts to really hit the tape, I'd like you guys to look up a term called money velocity and understand that when people are trying to exit, the flow of money and the downside effect happens a lot quicker than many may assume. My target, if the pain really takes place, is here. 160s on the SPY. You know, that would be just over a 20% correction. Remember, a correction in a market is anywhere from 10 to 20%. A bear market is beyond 20%. Am I predicting a bear market? No. I will say that I do incredibly well in bear markets. I prefer playing puts over calls. However, I participate on both sides of the tape. I don't call myself a bull or a bear. I just trade the chart. However, I personally enjoy trading puts more than I like trading calls. It's just my own personal preference. So let me go back on the cleaner chart. Right here. So where I just gave you that view would be a retrace to the 50. This is actually no, this isn't a 50. This is a 200 period simple moving average. Brings it to 157. Let me get on a monthly view. I have a 40 simple moving average at 164. Keep in mind, guys, that even if the market did retrace to these levels, that still falls within the structural realm of the bullish uptrend. So would I be looking to buy, in this area? Most likely, yes. However, if the level gets taken out and we see further downside and this bullish structure is breached, we get below this 156, basically where the bear markets really started to occur in 2008 and in 2000, we could be looking at a bear market, guys, and a retrace to here. This is your 200 period simple moving average on the monthly frame at 127s. So I'm not going to go that far to say that this is what is likely to occur in the future, because I don't know. What do I know? I'm just the guy on the microphone, right? But I'll tell you that my charts have been very reliable, and my forecasts have been reliable. I believe that my members could vouch for me in that regard. Keep in mind, yes, I am a day trader. I trade weekly options, but it's important that we have a general direction and a view of what is likely to occur in the future. So what am I saying? I think a correction is upon us. I think that the oil, the sudden crash in oil, may have been somewhat manufactured to stimulate the economy. Low cost oil, what does that mean? Lower cost of production, lower cost of manufacturing, general lower costs in distribution, and in turn would improve the bottom line of most businesses and the GDP. So that will generate more tax dollars to pay down our massive deficit. Perhaps that would offset what would occur if rates rise and it costs more for our nation to service our debt. These are some factors that are highly relevant at this moment in time, as our nation, or at least our Fed, just flutters around and kicks the can down the road, and the markets are just flying higher. So I'm not saying they can't go higher. I wouldn't be shocked if they did. I am just saying, please be cautious, because the guys, I don't listen to the TV. I don't care about the media. I don't care about any of the talking heads. I look at my chart. I listen to what my chart tells me, and we make money, and that's all that matters, right? We just want to trade the market and do what we do. But so that's it. So that is my forecast. I believe I'll repeat it, and I'll show you the charts again. Weekly view. If this volatility band gives us the volatility sell, and we test the lows of October, if possible, that would be your weekly 100 period moving average on an exponential. I don't think that it's going to snap back as quickly as it did before, just because in October we still had monetary stimulus. Quantitative easing was not over yet. This was the final phase, and we snapped to all-time highs in a heartbeat. If we take out these significant moving averages, all I'm going to say is watch out, because I see a $160 price target on the SPY if we do not see monetary stimulus in our um, federal policy. So, okay, that's it. That's a bold enough statement. Weekly chart, your daily chart, Friday's action. Yes, we closed above significant moving averages, but I did not like the action that occurred. Non-farm payrolls were very good, beyond the estimates. The unemployment rate went down. Very good news that just acted very poorly. The market acted very poorly after receiving that news. So I guess good news is bad news in QE and outside of QE. So that's ironic. But hey, so my forecast for this week, 202. I believe it should fill that gap. We have a gap here at 202s. Could happen as early as tomorrow. I am looking to short. I'm currently short Tesla. In our chat room, we have some people short the SPY as well, but I'm only holding Tesla as my short. And yeah, that's it. So that's enough for tonight, guys. I just wanted to leave you with that. So enjoy your evening, enjoy your trading week. If you have any questions, please email me, write me on StockTwits or Twitter. Please interact. I encourage you to. And I look forward to making another video shortly. Thank you.